Hey, Rick.
Hey, Megan. Good morning.
Good morning. Happy Thursday. We
I
are
know.
recording this today on this very gloomy
Hmm.
Thursday in June. That's what they say,
Yeah,
June gloom, right?
June gloom. Yeah, it's kind of nice actually for now. Till it gets
I
hot
know.
again.
It'll probably be September hell. You know what they say about September?
Yeah, yeah. Around yep, all through September, probably gonna be 95 every day
I know.
or
I
higher.
know. So I asked you on
Hmm.
today, and we're going to discuss something very important.
Hmm.
Some people, weigh themselves every day on the scale. They check their investments.
Uh-huh.
There's certain things in life that you have to sort of stay on top of. And one of those things is your credit score.
Hmm.
Your credit score determines what things are going to cost you. Um,
Right.
and I got, you know, I had a American Airlines credit card, because I fly back and forth a lot for family.
Hmm. Hmm.
And man, they charge you like $150 a year to have a credit card. I'm like, dude,
Yeah.
I'm doing you a favor here,
Yeah.
right?
I know, right?
Yeah. And so I, use it, pay it off, use it, pay it off. But then I'm like, you know what? I don't want to pay $150 a year. So I messaged them and they weren't willing to take the $150 fee off. And so I said, cancel it. Screw you guys. Well, guess
Hmm.
what? My FICO score went down like 30 points for canceling.
Because you closed the
Yeah.
account.
Yeah.
Uh-huh.
And what I don't, and luckily, I mean, I know that I'm in the position where I don't have to buy anything. I'm not in a
Hmm.
position
Hmm.
where I'm going to be applying for credit anywhere. But if I was, man, that could have been like a serious foul play, right?
Hmm.
Because
Hmm.
your credit score, they look at how much available credit that you have and
Hmm.
how much you're using it, what
Right.
percentage of it is used, and also
Right.
like, your, of course, your payment history and that sort of thing.
Hmm.
But
Hmm.
people think that your credit score is based solely on your payment history, or even payment history and inquiries. But in
Hmm.
fact, I think the big picture here is how much credit you have and how much
Right.
you're using. And then, of course, like how many years you've had those lines of credit, that sort of thing.
Yeah, it's a good point because I talk to home buyers and they go, I'm going to pay these accounts off. I'm going to close the accounts. Well, don't close the accounts. As you said, your FICO score is a function of certainly how well you pay your credit, but it's
Mm-hmm.
also a function of how much of that credit you're using, right?
Mm-hmm.
And so when people think, okay, I'm doing the right thing, I'm paying off my cards, and then I'm going to close them, right? Well, as soon as they close those cards, their available credit goes down, and so that means their usage goes up. So if they have, let's say they pay off two accounts and then they close the account, then they've got three accounts that are open that have balances. The reports think you're still using more of that credit. Now you've got less credit,
Mm-hmm.
right? So that actually drops the score. So people think they're doing the right thing by paying stuff off. Paying it off is the right thing, but the wrong thing is to close the account. Keep it open. And in
Right.
your case, even if you're paying some money to keep it open, for people looking to buy a house or refinance, keep those accounts open because your FICO score also impacts, guess what, your mortgage rate,
Mm-hmm.
right? So keep the credit cards paid down. And in terms of the kind of the model for that, what they look at in credit scoring is keep your credit card balances at about 30% or less of your credit limit.
Mm-hmm.
Okay, so if you have a $10,000 credit card, ideally in terms of the credit scoring models, you're going to be something less than $3,000 in the balances.
Mm-hmm.
But conversely, the more that credit you use, the more that impacts your credit score to the negative side. So, for example, I've got borrowers who have perfectly great credit, really good credit, no late payments, but they max out all of their credit cards. They're maxed out. They're paying them on time, but they're maxed out.
Right.
They've got low credit scores. And I call them up and go, hey, your credit score is this. And they go, wait a minute, this makes sense. I pay everything on time. That's true. That's important. But you're using almost all of that available credit.
Mm-hmm.
And that hurts the credit scores. Kind of
30%.
weird,
That's
right?
good. Now I know that
Yeah.
there's some sweet spots in credit
Hmm.
scores for sort of like the platinum the gold
Yep.
and the
Mm-hmm.
bronze sort of
Right.
level
Uh-huh.
of credit scoring.
Uh-huh.
Because like you said, your credit score has a lot to do with what interest rate you get.
Mm-hmm.
So
Mm-hmm.
what credit score is in the platinum department? What if all of the stars were aligned and you
Mm-hmm.
could have really great credit and get the best
Mm-hmm.
interest rate, what would be sort of the low end of that tier? Because we know that credit goes up to about, what is it, like 830? Is that the
I think
high?
it's 850 is the high score. Yeah.
I've never seen an 850. Have you ever
Me
seen an
either.
850? Yeah, I've seen
No.
830. So, so what's sort of the low end of that?
Well, in terms of getting the best mortgage rate,
Mm-hmm.
the top score is 740.
Mm-hmm.
So as long as you're above 740, that puts you in the best tier for rates. And someone will say, well, I've got a 780 or 800 FICO score, so I should get a better rate. Yeah, you're going to get a better rate, but if you had a 742 FICO score, it's the same rate as the 780 credit score.
Gotcha.
Okay, so once you go past that 740 FICO, it's the same great rate no matter how much higher it is over 740 in mortgages. Where you want to be careful is when it starts going down a little bit. They do those in 20 point movements. Okay, so between 720 and 740 is the next lowest score, and then so on and so forth in 20 point movements. So when you start getting below 700 is when you start getting the biggest hits to the interest rates.
Mm-hmm.
Even a 705 score is a very good rate. I mean, a very good score. But you're gonna pay a little bit more on that rate than you would at a 740 score.
Okay.
But when you start getting below 700, be careful. That's when it gets dangerous, and especially below 680.
Yeah,
When you
680.
start getting below 680, you get some pretty good hits to those rates.
So 680. So a 740 and above is sort of platinum. You know,
That is top tier.
680 to 740 is gold, but under
Right.
680 is
You're
might
in
be
trouble.
danger zone.
Danger zone, yeah. So, some lenders won't go below a 620 credit score. You can go really as low as 580 on some loans. For example, FHA can do a 580 score with 10% down on an FHA at that level. But when you start getting below a 680, what they call the price adds to the rate get pretty expensive. But it's also driven by how much equity or how much down payment someone is using. So,
That's right.
So for example, a 680 credit score with a 10% down loan is a higher rate than the same 680 credit score with 25% down. So the bigger the down payment, so a bigger down payment kind of makes up a little bit for that credit scoring.
That's right.
But when you start getting below that 680, I closed a loan this week with the guy had a 632 credit score. Okay, and he had really pretty good credit, but guess what? He was maxed out on all of his credit cards. Can't do anything about it. So he paid a higher rate. Okay, but you still get a loan. And then the game plan with that kind of a borrower is, once you get the loan, that helps your credit score. But then over the next few months, start paying down those credit cards. And the goal is to get that to 30% or less. And the key with that, again, as we said earlier, is when they start paying off those cards, do not close the accounts. That will hurt the credit scoring every time.
All right. So your tips are then not to exceed 30% of your credit limit. Keep your credit cards down 30%. Don't close your accounts if you're, going to be shopping for a mortgage in the near future. And then the last thing I wanted to talk to you about was rapid rescoring. And I wanted to kind of share my personal story with people here. And that is, during the Great Recession, I had one late payment. I was able to survive, but I did have a late payment. And dag nabbit, there it was on my credit. And really it was, my credit was sort of approaching one of those tiers at the time. And you said, hey, contact that creditor, and because you're in good standing with them now for years, and ask them if they would kindly remove that late payment. And they did. They wrote a letter, and I gave it to you, and you were able to do something magical with it, and then it bumped my credit score like 40 points or something.
Yeah.
So cool. Explain that a little bit, please.
Yeah, that's a great point, Megan. So there's a program called Rapid Rescore that we use internally with our credit bureaus. So when someone in that example, for example, you pay something off or you have an account deleted, it takes the credit bureaus typically 30 to 60 days to catch up with that data.
Mhm.
So it doesn't raise your score right away. On a rapid rescore, we submit that data to our credit bureaus directly, and they in turn reach out to all three bureaus, and then they manually adjust that score within a 5 or 7 day period, and that raises the scores right away. So if someone's buying a house, for example, the biggest issue sometimes is like medical collection accounts,
Right,
right?
right.
People get that. That's, those aren't their faults. Things happen, right? Sometimes the insurance doesn't pay
I mean,
something, and then they send it
medical, I
right
mean,
to
isn't that
collection.
like the number one thing that you see on people's credit
It
is
is.
medical bills?
It
Yeah.
is. But that's the one that's the most forgiving, because oftentimes someone will have a small medical account, $50 oftentimes, right? And then that becomes a collection account that hurts the credit scores big
Right.
time. So especially with the medical collections, we can pay those accounts off, but then you call the collection agency and say, look, I'll pay it off right now, but I need you to show this account is deleted on my credit scoring models,
Right.
and then send me a letter on that.
Right.
And so typically collection accounts for medical will almost always delete those accounts.
Mm-hmm.
And so when they show us a letter of deletion, we will submit that to the credit bureau, have that account taken off the credit report, and get that score up right away. Those are
Mm-hmm.
easy. Those are a pretty easy fix.
Yeah. Yeah. All right, good. Well, I think that is a lot of really solid information for today, and I appreciate
Cool.
your being here and sharing your 30 plus years of
I know, I can't believe it.
industry know-how with us.
It's
And
all fun.
I know we'll be here if anybody has any questions.
We're here for sure.
Have a wonderful Father's Day,
Thanks,
okay?
Megan. Thanks so much. I appreciate it. We'll talk to you
All
later.
right. Okay.
Alrighty.